After triple-digit losses in stocks on Tuesday, the markets are recovering, but amid volatility in the U.S., should investors flock to Europe, especially as central bankers look to revive the Eurozone's economy through a massive stimulus program? Let's ask David Lebovitz, global market strategist at J.P. Morgan Funds. And David, what's your reaction to the sell-off yesterday, though? I mean, stocks seemed to be recovering today, but certainly yesterday, I think investors were worried that the good economic data released might prompt the Federal Reserve to raise rates sooner.
Exactly, Scott. I think we are heading back into a period of good news actually being bad news for the markets. And when I say that, I mean, exactly your point. The good economic data does suggest that the Fed may hike rates sooner rather than later. Our view is that they'll hike in September, but I think that that makes markets a little bit skittish, and I think that this is an indication of the increase in volatility that we should all expect going forward as we approach that date for Fed liftoff.
Yeah, and when the Fed does pull the trigger, I mean, do you see a major panic throughout the markets? It seems like a rate hike isn't priced into the markets, otherwise we wouldn't have seen such a dramatic sell-off yesterday.
Our view is that markets will dip initially when the Fed hikes rates. There will be a little bit of that knee-jerk panic reaction, but historically what we've seen is that over the subsequent months, the equity market has actually moved higher, pricing in the fact that the Fed is hiking rates for all of the right reasons. We wouldn't be talking about higher interest rates if the economy wasn't capable of standing on its own 2 feet. So I expect that despite that short-term volatility, longer-term equity markets will be able to continue their upward ascent.
All right, let's switch gears and talk about Europe with the quantitative easing program there. I mean, do you see opportunities in Europe more so than the U.S., and if so, where?
I think that Europe is much earlier in the stages of their recovery, so there is opportunity there, perhaps more so than in the U.S. I think the bottom line, and we see this around the world, is don't fight the central bank. We're seeing massive amounts of liquidity injected into the European economy, the Japanese economy, now the Chinese economy. Central banks are playing a very significant role when it comes to global markets, and so I think investors should swim with the current rather than against it.
All right, and how do you do that in Europe? What sectors do you like?
So I think that one area of opportunity in Europe is going to be the European financials. 2014 was a tough year with the ECB taking over regulatory responsibility, the asset quality review. A lot of these banks basically spent last year on hold. So I think that we could see them outperform as things gradually normalize across Europe. I also think it makes sense to play the consumer story. Like the US, Europe is primarily driven by consumption. So those would be my two picks in that space.
All right, now is there a currency play in Europe? We've seen the euro's value drop amid the stimulus. That's probably going to continue, but of course, lately the US dollar has been weakening after months of gaining steam. So what's your take on how to play both currencies?
So I think the path of least resistance for the dollar is still up, and the path of least resistance for the euro is still down. I think that investors need to understand that currencies tend to be volatile, they tend to overshoot, and not bet on the currency as much as the underlying assets. So we're much more focused on earnings, the quality of those earnings, rather than trying to get the directional bets of currency 100% right.
All right, David Lebovitz from J.P. Morgan Funds, thanks very much for your time.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.